5 seconds.
Hello, and welcome to the June 2023 issue of the Zavitz and Sikora Financial Strategies video newsletter. Thank you for tuning in and listening to our update. I'm your advisor, Greg Sikora, and here with me today is my partner and your other advisor, Mark Zavitz. Today, we're going to quickly go over Canada has reached 4 million in population and what that means to you, as well as a nice financial graph showing that I think we're in the start of a bull market. Before finally, we're going to be diving into how I made $1,000 in just 2 hours of work. And I'm going to give you the information I used. So hopefully you can too. So first, let's touch on performance. Not much has changed over the past month. Performance across our various models. We're down about a fraction of a few percentage points month over month. We had stronger returns in March and April for all of our model portfolios. The conservative, very conservative, the moderate, and the growth portfolios all had 5-6% returns. Then inflation reared its ugly face again, end of April, beginning of May, and bonds or portfolios or models that have a lot of bonds in them, such as our very conservative and conservative models, they lost some performance because bond prices went down, because the expectation for interest rates has gone up. And we've already seen it with the Bank of Canada deciding it's going to be potentially raising rates another 2 to 3 times. That was a stark contrast to where we were, say, 3 months ago when the Bank of Canada was saying we're done raising rates. And that's all because inflation is proving to be much stickier than we anticipated. In our last 2 or 3 video updates, we also talked about where we think interest rates are going. And we were saying, at the end of the year, it's looking like interest rates are going to fall off, or at least that's what the market is predicting. Well, the market is now predicting for interest rates to stay at this elevated level, for them to actually go up, as I said, within North America, another 2 to 3 times, high probability chance of that happening, for them to stay at an elevated level until around this point next year. So another full year of high interest rates, if the economic data continues to be strong and robust like we see right now. As a reminder for what you're seeing as a slide, the growth model portfolio is around 15% stocks, equities, and 85% stocks and 15% bonds. Our moderate portfolio is around 65% stocks, 35% bonds. Conservative is around 45% stocks, 55% bonds, and our very conservative portfolio is around 30 to 35% stocks, 70% bonds. So, in case you missed it, and no, we're not going to talk about, submarine implosions and the war in Russia. The other big news that came out is that Canada officially surpassed 40 million in population size, which means that we're keeping pace with the state of California, who also surpassed 40 million in population size about 2 months ago. Mark, what's your take on the effect of this rapid population growth on Ontario and us as Canadians? Like, what do you see in this doing to us?
Well, I guess firstly, it's extremely positive for the economy. Canada, I think, is leading the G7, probably even the G20 in immigration, and these people are going to work, and so this is this extra 400,000 or 500,000 people a year that are coming into the country are being very productive. They're, for the most part, they're working, and we need them desperately. So they're younger. So this is going to help our age situation. Canada, China and Japan all the G7, have a very old population that's aging, and we're all facing huge challenges with healthcare and just everything. There's so many social services that are going to be affected by the aging population, and it's all going to be all of them are going to be getting so much more expensive. So the immigration is very helpful. Lots of younger people going to work, but just from a current events perspective, the all these people need housing. And so, one of the challenges for Ontario and Canada, certainly over the last couple of years, has been, the 500,000 people that are coming into the country need a place to live. We're not able to build anywhere near that number of new homes. So that's perhaps artificially inflating residential housing condo prices. I think we would have, I don't know what you think, but I think we would have experienced a much larger drawdown in values had we not had all this immigration.
Yeah, I mean, housing is typically much more interest rate sensitive than what has occurred, at least in Canada, over the past year and a half since rates started to rise. And you know, I have actually kind of expected prices to stay lower for longer, but the markets seem to have bounced back, at least in the months of April and May, like substantially. At one point, Canada in aggregate was down somewhere between 15 to 18% in residential real estate prices on a year-over-year basis, and now it's barely down 5% from the highs of February of 2022. So that's to say it could potentially, and I think it will go back down again as interest rates continue to creep upward, which is again a big surprise that's come out as inflation has remained sticky. But immigration has really continued to buoy these real estate prices, which most economists weren't expecting. And you said, 500,000 people. Actually, Canada brought in 1.1 million people, which is where we've started to notice some people getting upset with our immigration policies. And, for good reason. Like, we need these people. We do have an aging population, but our systems can only handle so much. I mean, everything gets bogged down. Real estate prices go up, infrastructure gets bogged down. Just think about how much more traffic there is. These people don't move to Northern Ontario. They move to Toronto, they move to the Niagara region, they move to Hamilton, and they move to other major cities. But it's the economic the effects on our economy, although positive, there are some other negative economic impacts that are certainly not being factored in here. So I don't know. I think if you're a lower or middle class Canadian or a lower class Canadian from an economic standpoint, you are essentially being left behind as these new immigrants potentially come in and do eventually work higher paying skilled jobs. It's creating this have and have not society with two socioeconomic classes, and it's exacerbating that. And I think if these people don't assimilate as well, there are some risks. So yeah, not to keep rambling on here, I just think that we need to kind of put a cap or we need to have some element of control. We can't have, 1 million people joining us on a yearly basis just because we don't have the right systems, infrastructure in place to be able to accommodate them. We need them long term, but short term, it's just causing a lot of damage.
Well, Greg, it's like anything else. Too much of a good thing is not a good thing. So you're right. There's a happy medium there. The country can only properly take on so many people a year. Like you said, infrastructure has to expand and get better, stronger, and Yeah, so who knows what the magic number is? Maybe a couple 100,000 a year, but it seems like we're taking in way too many now, and that's really bidding up the cost of real estate and other things.
Yeah. So I was mentioning before that we might be on the cusp of starting our next bull market, or we might even be in our next bull market. Here's a rather complicated slide on valuations and earnings. Not to get into the details here and to go through what exactly all this means, but the black line that goes up to 43.23, that's the S&P 500, which is the 500 biggest companies essentially in the world. This is an index of those companies and their growth since 2013 all the way to 2023. It's a 10-year look, and you can see the different economic cycles as denoted by the orange and the purple bar charts. Simply put, what typically happens during an economic cycle is that we see earnings per share growth go down as a cycle ends, and we start to see PE multiples actually start to go up on a year-over-year basis. And it looks like, just based off of those two measures, it looks like we're at the start of our next bull market. If not, we've already started one potentially in October or of last year or January of this year, after a year and a half of declines. And this also typically follows an interest rate cycle where interest rates are coming down. So the next shoe to drop in order to drive better valuations is actually interest rates coming down. And I think that the moment we start to see inflation getting close to that 2-year number, those 5% Bank of Canada rates that we're seeing right now, they're going to come down, and everything's going to follow suit, and we're going to have some really good returns in both stocks and bonds. It's already starting to happen. We've already got some decent returns year to date, but I wouldn't be surprised if we finished the year in double digits, or if next year was a double-digit year return for both stocks and bonds. At least that's always how it's worked historically. Who knows? But I wouldn't be surprised if history repeated itself in this regard. So, what some of you really care about: how I made $1,000 with roughly 2 hours of work. Drum roll, please. It is that I renegotiated my contracts. What do I mean by that? Well, I renegotiated my cell phone bill, my internet bill, my Sirius satellite radio bill, and partially did my RBC checking account. And I negotiated the contract down for most of these reoccurring bills by somewhere between 30 to 40%, using posted promotions I was either texted from competitors or things I found online. And all I did was I called the company that I was using for my internet. So in this case, I use Cogeco, and I guess I know most of you as clients, you guys use Cogeco. So all I did was I called Cogeco. I spoke with the retentions or loyalty department. It was around a 30 to 35-minute call, and it only took one call. And I negotiated with the retentions loyalty department person that I was talking to my existing internet bill, which was starting currently at $95, and I negotiated it down to around $55 plus tax, so it came into around $60. Now, this savings that I'm going to see on my monthly bill was done through credits. So they were able to credit me. I don't know how they did it exactly, what they called it, but basically just credits. And those credits last for the next 2 years. So I'm going to be saving $35 a month for the next 2 years, and that equates to around $420 a year. This is the promo that I used to negotiate. It's when I got texted. If you look at the screenshot here from Bell, Bell was in the area that I live, and I happened to use Bell for my cell phone. They have 1.5 gigabyte speed internet for $50 a month as a promo, and you can use this language here for when you call into your internet service provider to try to negotiate with them. If you talk to someone in retentions, the loyalty department, this is just important to add on, and you're not getting anywhere, please don't hesitate to end the call with that person. Call back, speak to somebody else, and try again. Sometimes, like in the past when I've done this, sometimes it takes more than one call, but in the end, it's worth it to be able to save this much money. Next thing I did was I renegotiated my cell phone bill. As I said, I was using Bell. I have, I had actually a 15 gigabyte plan, but now I have a 20 gigabyte plan. I was paying $75 a month just for my bill. It was actually, $66 plus HST, or $67 plus HST, came to $75. And I negotiated my bill down to $50 in the past 4 or 5 months. Since around February, whole bunch of cell phone package providers, Rogers, Fido, Freedom Mobile, they've all been getting super competitive. I don't know why, but they've all been offering new plans for substantial deep discounts. And I'm talking like, $40 to $50 plans. So the first thing I do is I'd recommend calling your existing cell phone provider and seeing if you can use some of these new plans that have just been made available as a negotiation tool or tactic, like the one I've posted here, to try to negotiate your bill down. If that doesn't work, I mean, if you own your phone, just change plans. Like, honestly, like if you're paying 90, $100, which I know quite a few people are for their cell phone, just change plans, save the $50 a month. That's $500 to $600 a year, and it's worth it. Next thing I did, I have a Sirius satellite radio in my car. I've had it for years. I didn't realize that you could negotiate with them, but you actually can. This one, I mean, Sirius satellite radio is a unique satellite radio offering, and there's nothing like that elsewhere anywhere else. So I was surprised to learn that you can negotiate with them, but all you need to do is call them and tell them that you can't afford the service anymore, and they will start throwing offers at you within like 5 minutes. It was so easy. I have one in each of my cars, so I have 2 times the subscriptions, and I was paying around $23 a month for each subscription, so $46 in total. They were able to cut that down in half, basically. So my new bill for both subscriptions is actually going to be $24. I'm going to be saving $22 in total, so that's a total savings of $264. Simply just call this 188 number, tell them you're having trouble affording the service. They will start throwing discounts at you right away. And the last thing I was able to save on, so if you work with a credit union, you likely have very to little, if any, checking account fees. But if you bank with a bank, you're probably used to seeing, a $10 to $16 fee per month hitting your checking account, just coming out. And that's for the privilege of using that bank. It's kind of ridiculous, but because they turn around and lend your money and they make a risk-free 5%. But anyway, you wonder why their profits are always so good. It's because they charge $16 in your checking account. One of the things that most banks offer are multi-product discounts or rebates. And I uncovered that, and I've got my mortgage and my my credit card through Royal Bank. I uncovered that if I added an investment product with them of $500 or more, I could wipe out $6 a month from my checking account fee. And if you're a senior, you can actually wipe out your full $16 checking account fee, which is great. So all I did was I bought a $500 GIC with the cash I had sitting around in my checking account to qualify for a $6 a month discount, which is going to save me $72 over the course of the year. Took me no time at all. You know, if you're a senior and you're tuning into this video and you can save $16 a month, well, that's, you know, $200 a year just for buying a $500 GIC, which is going to yield you 3 to 4% with the leftover cash you have sitting in your checking account. It's worth it, in my opinion. So that is how I ended up saving $1,000 in total. You know, I'd expect this to take 2 to 2.5 hours of your time to be able to save this much money. Your mileage may vary a little bit depending on the discounts you already have and the price you're already paying for some of these services. I was paying your top dollar, and just know that every year or two, I am going to have to go back in and to renegotiate. But for 2 hours of work, in my opinion, it's worth it to save $1,000. All right. So that's it. Last slide is the disclaimer. Thank you so much for listening to our update. I hope everyone is having a great summer. Feel free to reach out to Mark and I or the team if you have any questions or need any support. Thank you so much.
Have a good summer, everyone.